Hello, today is Thursday, July 18th, and today I'm going to tell you how to do a covered call. So first I'm going to talk about what is a covered call. I'll try to explain it as simply as possible without talking about all the advanced exceptions and the stuff that bad professors do when they want to show you how much they know about a subject rather than get you to learn the subject they're talking about. So I'm going to keep it real simple, and then we can go from there in subsequent lessons. I'm going to discuss it first, and then I'll show you with the options table, as you can see on the screen. But this is why I'm going to bring up the video so you can see my face more, because I'm going to talk to you about it first. So a covered call starts when you have 100 shares. So let's say Tesla. All right, I got Tesla on the screen. Ignore everything in the background for now. And I have Tesla, 100 shares. So you got to have 100 shares to sell one covered call against your stock. Now, why would you want to sell a covered call against your stock? The risk, and let me talk about the downside first. The risk is that, let's say you sell a covered call at $10 more than the stock is currently trading at. So that means you have a maximum profit of $10 on those 100 shares. If it goes above $10, the person who bought that call from you is going to exercise it, and then they will take away your shares after the $10. So for example, let's say you have 100 shares of Tesla, and the trade price is $200 per share, and you sell a call, one call against your 100 shares with a strike price of $210. So as long as Tesla stays at or below 210, and again, it can go up to 210, and as long as it doesn't go above 210, you're fine. But you keep all the gains from 200 to 210, and you keep the premium from that call option you sold. So what are the advantages of this? First, you lower your cost basis. What does that mean? That means the price you paid for the stock, it's cheaper every time you sell the call, because you're lowering the cost basis. You're getting a credit for selling that call, or else why would anybody sell calls? Because there's risk. So for a covered call, when you own the 100 shares, the risk is that you will miss out on profits above the strike price. So again, you have 200 shares, you have 100 shares of Tesla, and it's trading at $200, and you see that it would be a good time to sell a covered call. And I'll talk about what you would look for, such as high implied volatility, over bought conditions, why you'd want to sell the covered call, and what to look for when you want to sell it. But for now, just think you have 100 shares of Tesla, and you're selling the shares. You're selling the call against the shares for 210 strike price. And let's say you want to sell a weekly. Just to keep things simple, you could sell, obviously, the monthly, you could sell several months out, you could sell a leap long term, because you're going to own those 100 shares technically forever, until you either get a margin call or you decide to sell them. So there are people that have been doing covered calls so long that they actually own the shares outright. They've lowered their cost basis so much that they actually own the shares for free. And the reason they've done this, and the reason they've been able to do this, is they sold covered calls on a regular basis, either every week, every month, several months, and their shares never got called away. And every time they sold a covered call, it's a premium that they take in. It's almost like a dividend in a way, because it's a regular payment, regular disbursement that they can count on. Just like you have the ex-dividend date, and you know when you're going to get your dividend. If you're selling calls, then you know when you're going to get your call premium. And it gets pretty exciting, because as it gets closer and closer to the strike price expiration, you keep more and more of the profit. I don't want to show you an example just yet. Just want to say one more thing just to make sure everybody understands why we're selling a covered call, what the advantages are, and what the risks are. So, and if it helps you, you can write it down. I don't expect anybody to do this, but you could write it in a comment how you understand a covered call to be. Again, I don't expect anybody to do that, but that would be a good way to make sure you understand and then get some calibration from me or somebody else on what your misunderstanding is if you don't understand it. But covered call, let's say you have Tesla, you have 100 shares of Tesla. And if you have over 100 shares, you say you have 115 shares, you can still only sell one call. How many shares would you need to have if you want to sell 2 calls? 200 shares. 1 call per 100 shares. So you have 100 shares of Tesla, and Tesla's trading at $200. And you want to sell a call against your 100 shares that expires next week because you don't think Tesla is going to go above, let's say, 205. And it looks like it's on its way down because the stochastic, the RSI, the Williams, it's all overbought. It looks like it's ready to do a reversal. And implied volatility has been peaking because, let's say, there wasn't earnings or pre-earnings, not actual earnings, because implied volatility usually collapses after earnings unless it totally falls. Anyways, try to stay on point. So let's say there's a huge spike up in implied volatility. And that means the premiums will be even richer because implied volatility is essentially a risk premium. And selling the call is also taking on a risk. So that's why you're paid for it. So to go back to the basics, you have 100 shares of Tesla. It's trading at $200 right now. You don't think it's going to go above... sorry. Dogs just peed on each other. You idiot, Ned. All right, so you have 100 shares of Tesla, and it's trading at $200. And Tesla looks like it's overbought. So you're going to sell a call that expires in 1 week, and it's out of the money, meaning the stock would have to rise for the call to have intrinsic value. That's the most simple way to think about it. There's other factors, obviously, that play into options pricing, but what the point is out of the money means that there's no intrinsic value, because if Tesla's at $200 and you sell a $210 strike, that's definitely out of the money. And at the money strike would be $200, and in the money strike would be below $200. But that's another video for another day. Just making sure all the beginners can follow along here. So you're selling the call against the 100 shares, and you hope that Tesla will rise a bit, maybe even get up to 209, 210. You'll keep all those profits, but as long as Tesla doesn't go above 210, then you're good. Because if Tesla goes above 210, then that person who bought the call option will exercise it, because now they have locked in that purchase price and they can buy it for a bargain. So they're going to exercise it if it's above 210. They'll leave it alone if it's 210 or below. And that is why the option selling makes sense. And if it does start to go into the money before the option's expiration date, then you can roll the option and get yourself a little bit more time. So I hope that makes it as simple as possible. Selling a covered call. The visual next. But one last recap, because I have found as a student, it's easiest and most effective to learn something if you just focus on one very narrow focus and repeat it in different ways, but cover all the different ways of explaining something, and you focus on one topic at a time. I had terrible professors in college and law school that would present a subject and then talk about numerous ancillary topics to it, which completely clouded my understanding, and I came away with a little bit of a lot, but not a lot of anything. So what I'm trying to do here is focus on the covered call and explain it in different ways that all relate back to the same outcome and overall explanation. You are lowering your cost basis, or if you don't care about lowering your cost basis, you're just making a profit every week with very little risk. You really can't lose money if you think about it. You could lower your profit, but that's not the same as losing money. You understand what I mean? So you have 100 shares and you're not going to lose money by selling a call. You could lose money if the stock goes down, but what selling a cover offsets your loss, because you're selling a call that would make you money if the stock price goes down. Now, why is that the case? Because, there goes my dog. Because if, let's say, Tesla is at $200 and I sell the $210 call, as the price of Tesla goes down, then the price of the call option, the value of it, go beneficial to you. Well, first, think about the option buyer. They have an asset that is decreasing in value. And, don't argue with me on the meaning of asset, just think of it. They have an option that is decreasing in value because the price of Tesla is pulling away from the $210 strike price. So as it gets less and less likely that the 210 strike will be hit, the call becomes worth less. And that is bad for the option buyer. But what's bad for the buyer is good for the seller. So now, if I wanted to close out that option, not just wait for it to expire, but close it out, then I could buy it back for much cheaper. So think of selling a car. You want to buy a car, let's say, and sell it for higher. And that rarely happens, but just for argument's purpose, let's say you do it in reverse, and it's equivalent to short selling. So you borrow the money to buy the car, you sell the car to someone else, and they, oh man, this is a bad analogy, but then for the depreciation, but they're paying you for it, and then you buy the car back at the end for much cheaper than you're originally going to buy it. So that is one way. Like, just think of, buy low, sell high. Reverse that. Sell high, buy low. That's how you profit when you're a short seller. And when you're selling options, that is essentially being a short seller. So every point needs to be reiterated at least more than once if this is the first time you're hearing it. If you're selling a call option, the goal is to watch the price of that option go down and down and down until it goes to zero. And that, as it goes down in value, your profitability goes up. And you can see that on most trading platforms. I use Thinkorswim and the mobile trader app, which I'm on right now. And there's a PL percentage. And as your strike price, it gets less likely to be hit, either because the underlying stock price, let's say Tesla, is going down, or Tesla isn't even moving in price. And every day that goes by, you have something that's called just time decay, meaning there's fewer and fewer days left for Tesla to make a big move. Then that makes you money. And you also have implied volatility, and as implied volatility goes down, then it's less likely that it's going to make a big swing up or down. So the probability of it hitting that strike goes down. So those things all help you, the seller. And I have found that in more cases, you to more opportunities for profit. So every day that goes by and the stock doesn't make a move upward, it just stays stagnant or even goes down, that makes it more profitable for me as an option seller. When implied volatility is peaking and I decide to sell an option during that time, especially if it's, above 80% historical volatility, or like the 80th percentile. Of course, it could go a little bit higher, but if you look at the chart, it has more room to go down if it's in the 80th percentile. More room for anything to go down, whether that category is implied volatility, overbought, etc. So when things are off the charts, it's a good time to make a move because of mean reversion. Things that are in outlier territory tend to revert back to the mean. So what we're talking about in this case is I sell the call option, and I'm hoping that Tesla doesn't make a big move upward. But in the worst case scenario, it makes a huge move. It goes past 210, shoots up to 220. Elon Musk comes out and says, no, for real this time, we have buyers for the company. We're going private. I don't think that's going to happen again because he's afraid of the SEC, what happened last time. But if that happens, then my call option that I sold to the buyer is going to be in the money because I guaranteed them the right to purchase, my Tesla stock if it goes above 210 for a set price. So they're probably going to exercise that because it doesn't cost them any more to exercise it if it's at 215 versus 250, like 215 versus 250. They've already locked in their purchase price. It's an option to buy, and I have to honor that. I don't have a choice. That's a contract that I've voluntarily entered into. I'm locked into it through the options exchange, and without any further action on my part, they're going to exercise that option if it's above 210. I can't say no, but I can roll the option before it's been exercised. So what that does is I buy it back and I open a new position. So I sell, I've already sold the option, I buy it back, and that could be at a loss. So the reason I would roll the option is to protect my underlying shares. Let's say I think Tesla really could go a lot higher than where it is trading right now, and I don't want those shares to be called away from me, or maybe I want to keep the shares because of the dividend. So I would dispose of this call option, get that off the table, because that call option is going to take those shares away from me if Tesla is above the 210 strike price. See how it's all starting to make sense now, I hope? I talked about this in several different ways to try to approach it from several different angles so you can kind of be on the same page now when I'm talking about more advanced, more detailed topics pertaining to the covered call. If my approach is not helping you, please let me know. I want to get better. But I'm hoping this is how others can learn too, because this is the way that has helped me to talk about the same subject in multiple different ways. So relating back to what I was talking about, you roll the option because you want to keep those underlying shares. You don't want them to be called away from you. And the way you do that is you can click on the roll button on the mobile trader app, or you can just do it manually. And basically you're buying that short option back, and that could be at a loss because if Tesla is trading above the strike price, that option is going to be worth more than you sold it for. So you're buying it back at a loss, and then you're selling another option. And of course you take in a credit when you sell that next option. But let's say you think that Tesla is so hot, there's so much hype, implied volatility is high, so you think that you just need a little bit more time and Tesla will be down again. So that might be one of the reasons it makes sense to roll your covered call. In other words, roll that short call. So you buy it, and you buy it, at the expiration date that's coming up, and then you sell a new option at a further out expiration date. So it's called buying the front month, selling the back month. All right, I really want to wrap it up now. I didn't want to go over 10 minutes. I'm already at 19. But the covered call is a great way to lower your cost basis, or B, take in a regular profit, almost like a regular dividend, because you're getting a premium, and every time your covered call expires, you can sell a new one that is more calibrated to the current trading price of the stock. So, that 210 strike we sold because Tesla was trading at 200. Well, let's say, come expiration Friday, Tesla's trading right at 209, 210. So you wouldn't want to sell another call option at 210, because then it's essentially at the money. And the likelihood that Tesla will hit 210 is extremely high. And if you want to keep your shares, then that would be a bad idea. If you're done with Tesla and you want those shares to be called away, then sell it at 210 and they'll be called away, and you'll take in the premium. You'll have those shares automatically taken from you, and you can move on with another strategy. And that's another video on how to get into, how did I get those 100 shares? Well, I don't just buy them. I sell a put, one put, and then think about everything I just told you just in reverse. So if I sell, let's say Tesla's at $200 and I sell the put at 190, then as long as Tesla stays above 190, I'm keeping the premium and nothing is going to change. All right, so if I'm selling a short put, which everybody says is so risky, this is the risk. If you wanted to own Tesla, if you wanted to own 100 shares of Tesla, then sell a put, and you're going to get it at a discount from where it is right now. So if Tesla's trading at $200 and you sell a short put, then if Tesla gets down to 190 or below, those shares get put on you. And now I own 100 shares. And that's how I got into Tesla, at 100 shares. I didn't just buy them outright. I made premium every week until Tesla went down, and I got those shares put on me. All right, that is it. Next one will be a visual, and I promise it'll be shorter than this one. But I hope I covered all the bases and answered all your questions before you had to ask them directly. Thanks for watching.